Okay, so this is the Tesla chart. I'm just gonna share with you the framework that I'm using to decide why to invest in this stock, how to manage risk, how do I define risk, and let me tell you something very different to what many are used to, because I have a background in economics, finance, banking, and I really needed to adapt because to invest in innovation, specifically disruptive innovation, tech companies, you need to really evolve your thinking from P ratios, price to sales, margin of safety, not really. I'm going to explain that a bit later. But you really need to dump the efficient market hypothesis and expect the stock market to be a smooth ride. You need to embrace chaos, which is something that the father of fractal geometry, Mandelbrot, has already even talked about specifically in stocks. He even went on to prove how the market was more erratic, more chaotic than what traditional finance wanted to tell you. And um, basically, it's because people in finance wanted to make investing and stocks very measurable, in the sense that let's just put numbers in a spreadsheet in Excel, let's just discount cash flows, let's just estimate an ad for this and that, and voila, we're gonna have a formula that is giving us our risk, how the stock is gonna move. And yeah, deviations can happen, but they are very weird and they will happen like very rarely, just on the end tail of our bell curve. And that's not reality. Reality is chaotic, just as in life. Markets are gonna move a lot more than you expect, either up or down. You need to learn to embrace that. And I use it, for example, in the case of Tesla, which is just chaos, headline risk, and ups and downs, to increase my position via using call options when the stock is very down, even considering a margin when the time is right, using leverage ETFs, and then when it's up, hedging, because I don't want to sell my core position. Maybe I'll just sell if it's a hedge. Maybe I buy a put. Maybe um, I don't know. There's different. Maybe I'll sell a call. There's different strategies, but what I want you to understand from this is volatility is not risk. Volatility is just a feature, and we need to use it to our advantage. I define risk as the permanent possibility of loss. That's real risk. So based on that, now that I have expressed you this, I use a very simple framework to decide, now that we know this, why would I invest in Tesla? And that's basically, I will just say, if markets have this element of uncertainty just embedded in them, I need a risk decision, a decision making model framework that works well with uncertainty. And that's where I take EV, which is expected value method for doing the analysis for Tesla, which is very simple. It's very popular for poker because it already works with probabilities, not certainties. And that's something that you need to understand. The market is not going to give you certainties, which is what traditional finance wants you to tell. And if not, they want you to estimate the probabilities of very large movements to the upside or to the downside as so little that you don't need to worry about them until you do. So basically, expected value, if you don't know, I assign probabilities for the different outcomes that can happen to the business models: Optimus Robot, Robotaxi, energy storage, the electric vehicles, of course. And then just based on the growth that I estimate and the impact that it will have on the share price, I just put a probability on that. Of course, I also put a probability on loss or a downside move, and I multiply it by the share price. For example, I assign a 2000 share price probability of maybe 15%, an $8,000 per share price of 5% probability. and so on. I multiply them and then I just add them up. It's gonna give me a number that, if within my framework is acceptable, within a threshold, I will make the bet. And also, I combine it with a very simple decision making model, which is asymmetry. If I'm gonna risk $1, I want to receive at least $5 to $10. That's an asymmetric bet, and that's something that I need to see. For me, the threshold is 5 to 10. For some other people, maybe 2 to 1. For some others, 4 to 1. But for me, 5 to 10 is my minimum acceptable threshold, and that's what I'm seeing with Tesla. So combining expected value and the asymmetric bet framework, of course, I do my due diligence on about what the future could look like, simulate some numbers, and estimate probabilities. I'm not gonna get into Kolmogorov probability theory or what frequent is probability is. It's a topic for another part of the video. But if you want to learn more, let me know. But this is it. This is kind of also a record in the internet for when people are asking, how did you know that Tesla is going to be at 4,000? How do I know that you were really buying when it was at 160, at 200? How could anyone know? Well, this is it. If you want certainty, you're going to pay it. You're going to pay $1,000, $1,500 when Robotaxi is out there. If you want to invest with uncertainty, this is the way. This is the way to exponential returns.